Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. Okay, so the changeover gapping action at the end of last week into this week only accelerated a move down which had already been codified by the weekly key reversal down made during last week. The changeover gapping action took out the previously highlighted congestion at 1378, a congestion that had been evident late last year and also March this year. This is now resistance. The move down also highlighted the March to date action as being a bearish halfway hesitation instead of a possible double bottom. Interestingly, the gap lower punched down right through the potential target for this bearish pattern, which would have been in the 1350 area. Then on Tuesday this week, prices made the momentous move, not the obvious one of punching and closing below the middle tine of the redrawn and more acutely bearish March to April bearish Andrews pitchfork, which is currently at 1312, highlighted dark blue on my daily chart. This was a significant move, but no, it was the move down and closed below the key 1300 level. Thus, beans were no longer in the teens. Yesterday, the move lower punched down through and closed below the 50% Fibonacci line of the April 2020 to February 22 move at 1289, as if it wasn't even there. This was the first support of note below the middle time. Below now, we have support at 1243 and then the December 2021 low at 1223, and the descending lower time currently at 1218. This brings me to my comments from 9 weeks ago when I addressed some possible answers on what would be next by looking at the longer term charts, and I quote, "The possibility that we now have a February 2021 to date bear flag. This has set up the opportunity. It would very much now depend on two factors. Will the market halt at the congestion at 1378, which had formed the lower trend line of the descending triangle from late last year, and if not, will it halt at the July 22 low at 1304? If the answer is no to both, then we may well have a bear flag formation with potential down as far as the 1120 zone. Quite a big move if it does come about." And that's the end of the quote. Well, despite earlier indications of reluctance to move lower, things have turned and we are now on the way down. So what longer-term roadblocks lie in the way? Or should I say, what ones still lie in the way after overcoming 1289? Well, the first one is a 2021 low at 1181. This is still far away, but worth noting. Secondly is the 5-year moving average, which is even lower, currently at 1174, but which may soon reinforce the 2021 low. Finally, once again, I've repeatedly cautioned on this. I am not a follower of Gartley analysis, mainly because I have not had the time to study it properly. However, I am minded to look at the action from July 22 to date as having elements of a possible Gartley butterfly pattern. I'll just leave that bit with you. Chicago soybean meal. I feel obliged once more to start this commentary, again noting the monthly key reversal down here in March. Now, I'm sorry I know I've been repeating myself here yet again, but the situation deserves repetition. You see, for months now, we've had different patterns, not so much melding in with each other, but rather crashing in and out of each other. The bigger pattern here is the May to date seemingly broken, then repaired, then apparently broken again, ascending, expanding wedge pattern. A huge pattern that I had pointed out many months ago. It was never a perfect pattern by any means, but it does seem to finally be working. To assist in seeing this, I have highlighted it in dark blue on my daily chart. It is worth noting the lower trend line is also the neckline of the huge December 2021 to June 22 head and shoulders continuation pattern, currently at 423.30. The break lower from this, let's be honest, this break below this huge pattern indicates a potential primary target well off the bottom of my daily chart at an incredible 324 zone, and a secondary hard to reach, much harder to reach, target in the 283 zone. Well, these are ones you can put in the back of your diary and maybe look at once or twice a year. There is, however, a nearer, more immediate pattern or patterns to look at. These are the early March to date bearish halfway hesitation pattern with potential target X down in the 405 zone, around the 50% Fibonacci line of the October 2021 to March 23 move at 403.60. Then there is the smaller potential bearish halfway sensation formed from the mid-April to date, from mid-April to date, from the second leg of the larger October 21 to March 23 move. Actually, it should be October 22 to March 23 move. Correct that. This has the potential target X1 in the 390 zone. This is a less fully formed pattern compared to the larger pattern, but it is still there. Only a significant move back up over the flatlining long moving average, currently at 440 even, would offset such a move. Chicago soybean oil. A pattern which I highlighted some while ago has come back into recent prominence. It is the late November 22 to date descending wedge pattern. This is highlighted in purple on my daily chart. Currently it's 52.63 to 47.27. This ties in with my comments from 8 weeks ago when I looked at the longer term picture and said at the time, and I quote, "Looking at a longer term chart and we can see a topping action in formation, though whether it is a lopsided head and shoulders top or a lopsided diamond pattern is still a little open. What we can see is that the 51.10 to 51.20 area is key because of the low from December 2021. Below that, we seem to have fairly free area until the 50% absolute Fibonacci line at 43.82, and that's the end of the quote. Thus it seemed then, and it still seems, as if we are in a bearish trajectory and ties in with the late November 22 to date descending wedge pattern. Whilst looking at this longer term pattern, I again noted the last of the moving averages, which are still below the market. And that's the rising 5-year moving average, currently at 45.59, just ahead of the 50% absolute Fibonacci line. So overall, we still have the same pattern. Until this pattern is broken, it will continue to show the overall bearish, larger angle of attack of this market.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.